What are my chances of getting audited? So, this question, I think we can probably spend a couple of hours talking about this, but I'm going to give you my 2 cents on it. So, for example, if you look at it and analyze different kind of statistics, you can get some data around that. For example, if you're a minority, you might get audited more than the mainstream people. If make too much money, obviously you can get audited, and so forth. So you can find a lot of different data points about that. IRS publishes a publication, I think it's called 55 if I'm not wrong, and every now and then they will publish data in there for you. So if you want to go check that out, you can see all kind of details. But we cannot do our tax return based on this kind of data. We cannot say, you know what, let's just say because I make this much income, I have less chance of getting audit, and if I make this much income, I have more chance of audit. I don't think that's a right way to really look at this problem. I think the better way to look at this problem is, what can I do to reduce my chances of getting audited? Like, I cannot change my race. I cannot become from minority to majority. I cannot dramatically increase or decrease my income. There are a lot of these things that you hear online are out of your control. There's nothing you can do about them. So why not focus on things that you can actually control? So, for example, basic things: make sure the social security matches with the name and the name matches with social security. If there has been change in your name in social security, update that properly. So that could be very simple. Make sure the income matches with what you're claiming. So sometimes people randomly, miss out on certain kind of incomes, and somebody else might file a paperwork with the IRS and let them know that there is additional income due to you. Simple things like that can definitely help you. In addition to that, then the structure of your entities. So I see a structure problems many times. For example, if you are retired and you are doing some business activity, then I would probably structure it differently than someone who is younger. If you're husband and wife, maybe wife has a W-2 job and husband is doing some business, then I will probably structure it a little bit different. If you are doing trading activities, and you want to claim some of the business expenses under your trading business, once again, I will structure it differently. If you have a lot of real estates and maybe you manage those real estate and you're trying to take advantage of some of the strategies around real estate, then I'll structure them differently. And why structure? Because structure makes a huge difference, because IRS is looking at numbers. That's what you present to them on your tax return and the other data. And they need to make sure that these numbers make sense. So sometimes if you have a wrong structure, even though you did your accounting right, even though you did your tax return right, even though your bookkeeping was right, but to IRS that transaction will still look funky because the proper structure was not set up for that transaction. When you are doing larger transactions such as buying and selling or something like that, it is easy for you to miss something. So having a tax professional help you with those transactions can be really, really good. Funky expenses. And I use the word funky because I don't want to use the word illegal expenses, because uh, I mean, what is legal and illegal, right? It's not like clearly defined. Basically, something that is unreasonable for business to claim, you should not claim. So many times people get audited because they were just way too aggressive in claiming. And now I don't, I'm, and again, I want to just clarify that sometimes people don't even claim what's due to them. So they're just not, you know, they're not taking advantage of the opportunity that is due to them. But on the other time, some people just go way too aggressive. Sometimes people just miss out on the requirements of claiming certain things. For example, maybe you're claiming yourself as a real estate professional, but you're also having a W-2 job. These two doesn't really go together, because if you're a W-2, that means you're spending most of your time there, but then you're telling IRS that, hey, I'm a real estate agent and I spend most of my time in real estate. So like two conflicting statements. So make sure you qualify for what you're claiming. And even though if the system don't catch it, maybe you get caught in something else, and then IRS will investigate everything, and then you can get into trouble. So that's my thought process about getting audited or not audited. So when I work with my clients, my job is to advise them on things they should do to avoid getting audited in the first place. And let me add two more cents to it. Even if you got audited, it's not the end of the world. So here are my suggestions if you did get audited. Number one, read the notice carefully. Are they really auditing, or they're requesting some information, or they're making an adjustment? Number two, do you agree with those statements or you don't? If you don't agree with those statements, then provide proof to IRS and let them know why you do disagree with those statements. And number three, if needed, involve your tax professional. I'll start with whoever filed your taxes to begin with. You can ask them for their help, and if you're not getting much help, then maybe consider somebody else who can help you out with that. So that's how I look at the chances of getting audited. Please try to stay away from these facts, these numbers that you see online, because I would not lose sleep over those. I would rather work on things that are under my control. I'll try to avoid making some mistakes. I'll make sure my tax return is as accurate as possible. And if I still get audited, then all I have to do is respond to IRS, let them know why I did what I did. So if you do it that way,